Hey, it's Sarah here from In Accountancy, and today I'm going to take a look at payments on account. Now, payments on account are one of the biggest reasons that we ask people not to wait until January to complete and submit their tax returns, because you can really get caught out by these. Payments on account kick in whenever the tax you're paying on the previous year's profit is greater than £1,000. And whenever this happens, HMRC kind of reckon that next year you're going to make a similar amount of profit. Therefore, they'd like to get that tax in up front in advance of the year. So they ask you to pay 50% of the anticipated tax in January and a further 50% of the anticipated tax by the end of July in the same year. So let's take a look at a worked example to try and flesh this out and make it a bit more understandable. Okay, so if you've got profit in your sole trade business of £20,000, firstly, you're going to pay Class 2 National Insurance contributions of £158.60. Secondly, you're going to pay Class 4 National Insurance contributions. If you've watched my other videos, you'll know that Class 4 is paid currently on profits exceeding £9,500 and below £50,000 at 9%. So that 9% on 10,500 is going to be £945. Okay, and then we're going to pay income tax on the excess of the personal allowance in that 20,000. So that's 20% income tax on £7,500, which is £1,500 of income tax. So if you're working this out ahead of time, come the 31st of January, you can total that up and you're going to have £2,603.60 of tax to pay. But you've gone over £1,000. So if you've not had payments on account before, this is where it's going to really hurt. So we take out the Class 2 National Insurance because that doesn't count towards payments on account, but the Class 4 does, and so does the income tax. So that means that you're going to pay an additional 50% of £2,445 in January. So that means an additional £1,222.50 on top of the £2,603.60. So that means your total tax liability, shall we say, in January, in this instance, is going to be 3,800, I nearly said 38,000 there, that would not be good, £3,826.10. So that's what you'll have to pay in January. And then in July, by the 31st of the July following, you'll have to pay a further £1,222.50 to bring that all in line. Now it does get knocked off then in future years, but if you have a growing business that's continuing to grow, that payment on account amount is also going to continue to grow. So we do recommend that you get things done as quickly as possible after the end of the tax year, which is the 5th of April each year. So you've got plenty of time to plan ahead and know exactly what tax you're going to pay. In this year, so I'm filming now in January 2021, and as we all know, 2020 has been an absolute nightmare of the year. So if you're doing your 2020 tax return and you've had high profits, but you know that 2021 has been a disastrous year, you can apply to reduce those payments on account. Just be careful, because if you reduce them too far and it turns out that your profit actually was higher than anticipated, you'll have to pay interest on the payment on account bit that you didn't pay. So you've got to watch out for that. What we tend to recommend is get past the 5th of April, actually bring your tax return up to date as quickly as you possibly can for the next year, and then you'll know what your tax position is, and then you'll also know whether you can legitimately reduce that July payment on account. So I hope that helps you understand what payments on account are all about, but also helps you perhaps understand why we like you to plan ahead for your tax bill and not wait till the absolute last minute. If you like what you hear, please give us a thumbs up, hit subscribe, share, tell your friends about it, bring some more people over to the channel, and leave a comment below or let me know exactly what you'd like to see in the next video. I'll be happy to help. Bye for now.